Hello and welcome to FT Markets here in New York. It's banner days for the US equity market at the moment. We've got the S&P up nearly 7% year to date in record territory, and more importantly closing in on the fabled 2,000 point mark. So what could possibly derail equities in the next few weeks? Well, we've got the second quarter earnings season coming up, and we have seen a bit of a drop here in estimates for the second quarter earnings results. But to discuss the outlook for second quarter earnings, I'm joined by Nicole Bullock, who's our equity market correspondent here for the FT. Nicole, thanks for joining us.
Sure, thank you.
So what shapes has been perhaps the biggest test here, do you think, for the equity sentiment as earnings season starts to unfold? We sort of get the financials coming for the first week or so.
Well, certainly the level of the stock market coming into this earnings season really ups the ante for what will play out. Last quarter, in the first quarter, anybody who had less than stellar results or maybe disappointing results was able to blame the terrible weather that we had throughout the U.S., very, very cold winter, for some disappointment. So obviously this time around, we don't have that. Companies don't have that to fall back on. So we'll really get a better test of how corporate America is doing.
Right, and obviously analysts are expecting year-over-year quarterly second quarter earnings growth around 4.9%. That's dropped down from about 6% since the start of the second quarter. That's not unusual to see the analyst estimates get cut. I suppose the real factor here is what are companies going to say, because there's a lot riding on earnings expectations for Q3, Q4 and into next year, because if we look at the forward 12-month earnings, we see the S&P's trading at about 15.7 times forward earnings. That's historically very high.
That's right. And one of the things that we've seen happen over the last several quarters is that you've had companies achieving earnings growth primarily through margin growth and also by buybacks, which basically enable a company, depending on what shares they're issuing, can enable a company to boost up their earnings per share, because you're basically just splitting the profits over a smaller pie. So what anybody who's really scrutinizing these earnings this time around has to look at the quality of earnings growth, because earnings growth through buybacks and share cancellations is not really considered high quality earnings growth. I mean, it's certainly the math is the math, but you have to look at what is actually driving that. And as we've come into the quarter, we've also seen analysts cutting revenue expectations. So the revenue piece of the pie there has not really been coming through, because the economy has still not certainly not been gangbusters. So to your point about looking at second quarter in the trajectory of third quarter, fourth quarter, and beyond, we really have people waiting with bated breath to see this economic acceleration. And so the extent to which we can see that as a prelude in the second quarter could potentially make people a lot more excited about the upcoming quarters.
And certainly it's going to be remains the case here that there's an emphasis here on cost cutting, given the fact that earnings are expected to rise 4.9% over the quarter on a yearly basis, whereas revenues are only expected to grow about 2.7%. How long can the cost cutting continue, do you think?
Well, that's one of the biggest questions is, at what point are we going to see that top line kick in? Because we've had so many years of cost cutting coming off of the recession, and people really are managing to capacity. So
right.
We'll have to see the extent to which we can start to see that volume growth kick in for people.
And just quickly looking at the top 10 sectors that make up the S&P, one of the notable things when you look at this expectations for earnings is the fact that financials are the only sector that's actually going to be negative on the quarter. What explains the problems we're seeing with financials? Because there is this sort of idea that the stock market can only really rally hard when you've got a booming financial sector, but we haven't seen that at all in this recent rally.
Coming into the quarter, we've already seen several of the big banks talk about declines in trading revenues. We've had a period of extremely low volatility over the past several quarters, but we really had a leg down in this quarter, and so you have the banks warning that their trading revenues are going to take a hit. So that's one element, and it comes on top of many years of investors waiting for loan growth and margin growth to kick in for banks. So coming off of the recession, we just really haven't had that aspect to things. And so, banks are very leveraged to the economy. So once the buy side or the buy case on banks is that once that kicks in and you have the economy start growing and interest rates start rising, then banks can start lending more and lending at higher rates. So that's the buy case. But unfortunately, it's taken a lot longer than everybody thought for that to kick in. We're about a half decade away from the crisis and the recession. So until that piece of the puzzle really kicks in, it's going to be a struggle for banks.
Right, well great, thanks so much Nicole. So obviously a lot of focus is going to be here on the actual tone of the earnings, what are companies actually going to be saying, what is the guidance, how do they see the economy coming back, because really at the end of the day, in order to justify these current record prices for stocks, you do need to see top line growth accelerate, you do need to see the economy improve, and from there push the stock market even higher.